Today I want to spend a few minutes talking about the concept of employee benefits in Catholic schools. Now, this is important because if you're going to be the leader in a Catholic school, you need to understand clearly what the benefits are, and number two, the costs associated with those. As we've read in multiple accounts, in magazines, online, you've seen it on television, people talking about the cost of healthcare, and there's a great debate in this country about healthcare and retirement benefits. And that's what I want to spend a little bit of time on today. And what it amounts to is, in terms of healthcare, what is the cost to the employee? What is the cost to the employer? And is that consistent with your school's mission and philosophy? The other is retirement. In the past, for a number of years, there were programs called defined benefits programs. That meant that you, as an employee, went to work every day, and you didn't really need to put one dime into it. The school paid a percentage of your salary into an account, they managed that, and then when you retired, you got a check. Now, the problem is the expectations with those particular accounts revolved around getting an interest rate of 8% or 7% or 6%. The reality today is that that's more and more difficult. In fact, I'm not sure where you're going to be able to get 8% interest on most investments today without having incredible risks involved with it. So we have a defined benefits plan. Many schools have started phasing those out. And you have the 403B, which is the 401k, but for nonprofit institutions. That means that you, as an employee, get the opportunity to take your money, pre-tax, put it into an account, and you cannot touch it, really, until you retire without a rather large penalty. But you get to manage it. You can take all the risks that you want. But at the end of the day, if you take those risks and when you retire, there's nothing in that account, that's your problem, not your former employer's. So again, the shift of responsibility has been away from the employer, and more of the risk has been shifted to the employee. So I'm going to go through a number of screenshots from, first, the Diocese of Sacramento in California. And the second is from the Archdiocese of Louisville, Kentucky. You'll see their plans and how they function in both of those. So I hope this information helps. I'm going to take a few minutes and talk a little bit about benefits. Now, you've been studying those over the last few weeks, and you've been talking about benefits in terms of your own school. Now, for some of you, you have had difficulty getting some of the material from your schools. So I thought I'd kind of give you a summary of one particular diocesan plan. And this is from the Diocese of Sacramento, California. And on this particular webpage, they have all the lay personnel policies and forms. Now, most diocesan webpages should have something like this. This is one of the better ones because it goes into a little bit more detail, because it tells people about job application materials, background check materials. It says new materials for employees. So you can see all those different things. But I really want to talk about employee benefits material. Now, the first thing is this lovely sheet here that says, let's take a look at the premiums. And this is the group benefits plan. And as you can see here, it says for the employee only. It says, okay, what we are going to do is we are going to pay this premium of $701 if you select this particular medical option of the PPO, which is the higher end. We'll pay $701. Well, not really. That's what we, as the diocese or the parish or the school, that's what we need to pay monthly. Now, the employer says, well, we'll be generous. We will give you an additional $631.41. That's what we will cover. And as an employee, what you're going to do is we're going to charge you only $70.11 a month. Now, that's a great deal because you're getting complete coverage, high end, and all you're paying is $70.11 a month. Now, that's a great piece. Now, what if you have a dependent? You have a child. Your spouse is not going to be on your plan because your spouse is covered by his or her plan. But you said, okay, now let's look at this. So, additional cost to add one dependent, you add another $758. That's the monthly premium. Now, suddenly you say, okay, the employer is only going to pay of this additional $758, they're only going to pay $189.58, and you're responsible for the other $568.72. So you add this number, the $568 and the $70, and that's what your monthly premium would be. Now, if you decide additional cost to add 2 plus dependents, so really this is a family plan, what you're going to wind up paying in addition to this $70 is $818.14. Now, if you go down here to the next category, and again, you'll see the same breakdown, employee only, additional cost to add 1 dependent, additional cost to add 2 plus dependents. So that's the husband and wife plus any number of dependents you want. So there, you're talking about your cost, if you have a family, the 531, the 6, the 365, and the 46. That's what you'd pay. Now, if you go down here, you go, all right, now what am I getting? Well, I'm basically paying a little bit less if I go to the HMO. Now, in here, the vision plan, you'll see employee, that's what the charge per month is. Okay, and then you'll see the cost down there. If you have dental, they have this. You can see the $50.43 for the employee. And again, you'll see those charges there. Standard life insurance. Okay, and you'll see that the school or the diocese is basically picking up the charge for that. To age 75, if you died while you were working for them, you'd get a whopping $25,000. If you retired at the age of 70 and over, it's basically, if you're working there, it's $13,000 as a benefit. But again, you don't have to pay for that, but the school does. So when you're looking at preparing a budget, you have to factor these numbers in. Standard basic dependent life, okay? $10,000 for spouse, $5,000 for child. Now, again, you as the employer or as the head of the school, in terms of planning your budget, you need to make sure how many people are involved in this. So you look at the $3. And then long-term disability. Okay, some schools do not offer this. They should. In this particular case, it's not that much, but again, and long-term disability basically covers 60% of your wages. Now, if I go back here and you look at some of the forms and the election forms, and what this is basically doing is asking people to tell me what is it that I want for coverage, and they give you the options. And then this is basically what you would use to factor in how much you need to spend on your benefits for the following year. Again, this is only health related. And again, please remember for your employees, they get pre-tax monthly premiums. They can take that out ahead of time. So you fill this out and it's given back to the school. So now when we go back a second to the forms, you'll see schedule of coverage. And again, in everyone's handbook, this should be there. It should say the medical insurance, when it starts. Again, this is critical for new employees. Dental and vision, if employee is hired the first day of the month, coverage is effective the same day. Okay, so it tells you exactly what you're getting. Now, you suddenly look at the retirement plan, and that gets a little bit more complicated because in this particular case, they have a 403B plan. And it's a very nice document, as you can see, and it says a time to dream. If you're living the American dream or simply living in America, it is given that you have competing financial priorities. What can you do to prepare for your life after work? Where will you be? What will you be doing? And then this particular brochure talks about pre-tax dollars. And it's very nice because it gives you this breakdown. And hopefully all of you have seen this. Now, if you decide that the contribution that you want, you'll see the 4%, $800. It breaks it down there so you can see exactly what it is. This is something that you as the employer need to make sure that you're very familiar with. Okay? Now, in this particular case, they ask you what, some important things are. What do you expect to tap into your retirement? When do you expect to tap in? What do you expect to happen for your pay in the next 5 years? So this gives your employees an idea about what to look for. And then you'll see, as most of you are already familiar with, looking at your portfolio. Because in a 403B, you as an individual controls it. The school does not. The diocese does not have anything to do with it. They basically give your money to the company, and then you and that company work out your plan. And again, they talk about times to enroll. Now, again, very simple, not a big deal. Now, when you look at this, you'll say, well, that's fine. What about my benefits? Well, let's take a look at this. Okay? And in this particular case, it says eligibility if you work 20 more hours a week. And then they basically say a pay credit is accrued in your pension account each year starting January 1st. It is equal to 6% of your earnings for that year. Interest credit is added to your pension account each year at a specified annual rate, which is currently 7%. Now, what does that mean? That means that the school is putting in X number of dollars. Okay? They are giving you a particular option. Now again, these are the key features of the plan. Pension plan, all full-time lay employees, participating employees within the Diocese of Sacramento are automatically covered upon meeting the 1 year of service. So the first year you don't get anything. Your pension account balance will be credited each year with an equal amount of 6% to your pay. So why is this important? Because as you prepare your budget for the following year, one of the things that you need to make sure that you do is realize that 6% of each individual person's salary, whether that's maintenance or teachers, support staff, other administrators, 6% goes automatically for their retirement. So you have to budget that in. And then it says down here, your pension account balance will be credited with interest each year. Currently at 7%. Your account will not be affected by the investment returns of the plan's trust fund. Now, one of the things that you might have noticed is, well, wait a minute. How does this factor in with what I just showed you with the 403B? Okay, now, here's the interesting thing. Because in this particular case, this is a defined benefits plan. Now, a defined benefits plan means that you as the individual don't put anything into it. It is not a 403B. You don't put anything in it. Your employer puts, in this particular case, 6% of your salary. 6% of your salary goes into an account. You don't have any control over that. You, as the employer, as the principal of the school, let's put it in those terms, you give it to the diocese, and the diocese basically will invest that money. Now, if you're an independent school, that means that you are looking at investing that with, it could be with Merrill Lynch, it could be with UBS, it could be with a number of companies, TIAA, Kraft, whatever it would be. And they control it. You as the employee have nothing to do with it. Now, what's interesting here is that in a 403B, that's just pre-tax dollars. That's money that you're putting in and you control. Now, in this particular case, well, what does this mean? This means that if you see this section says years of service and whether you're vested, this basically means that this is what you get. Years of service. If you work for the school, or the diocese in this case, less than 3 years and you leave, you don't take your retirement money that's been put aside with you. What happens is that goes into the bigger pile. You get zero, nothing. Now, if you are there 3.1 months, all the way up to 4 months, you can get 20%. So if you leave at the end of your third year, you will have a small amount. So you'll get 20% of what you would have gotten if you lasted 7 or more years. And you'll see the breakdown. 4 but less than 5, you get 40%. 5 but less than 6, 7. 7 or more, you get 100%. Now, what's interesting here is that this is 100% controlled by the employer, or in this particular case, the diocese. Now, these types of plans are becoming obsolete. Why? Because they are assuming that they are going to get a certain percentage of return on investments. The old policies used to say that we were going to get about 8%. Now, I don't know of anywhere today where you will be able to invest your money to get 8%. It just doesn't happen. Even in the stock market, if you're really, really good, maybe you'll get 7%, but when you take out fees, it drops it down considerably. So, a lot of these plans have been eliminated because they were getting way too expensive. And there was what they call an unfunded liability. Now, it's really important that in your particular school, you have all of these things laid out for your teachers. It is your responsibility as their immediate employer. If you're a principal and you work for a parish, you need to make sure in your handbook somewhere it outlines all of these benefits. Why? Because your employees need to know that. And you, as the person that will be paying out for leave, for retirement, for health benefits, you need to know what your cost would be. So again, this is one particular way of looking at it. I hope this helps a little bit. I would strongly encourage you to go to your diocesan office. If your school cannot provide the materials for you, I would strongly suggest you go to your website or go to your diocesan office and ask them for the materials relating to employee benefits. It's important that you have it. It's also important that your teachers have it. I hope these thoughts help. If you have any questions, as always, please feel free to let me know. I'll be more than happy to talk to you about it. Now, I would like to take a look at another plan that is out there. This is from the Archdiocese of Louisville, Kentucky. And this is the Employee Benefits Program for 2015 and the summary of the plan. I'd like to go through this just so that you're clear. And again, it's really important that these documents be available to your teachers. First of all, this has the table of contents. We talked about the flexible benefits, advantage, participation, short-term disability, and so forth. Now, when we get down, what does it say? It says that the Archdiocese of Louisville provides a flexible benefits program that offers a variety of benefit choices. Now, who can participate? If you meet both the following conditions, you're eligible to participate in the flexible benefits program. You're employed by a parish, school, or participating agency. You are either a full-time employee or a school year employee providing 30 or more hours of weekly service. Okay, now, this also talks a little bit about changing the benefits election during the course of the year. And again, general laws require the benefits you select remain the same for the entire plan. For most people, that's not a problem. Now, let's get into the benefits. And this is important because you, as the person that's going to create the budget, needs to make sure that you fully understand exactly what will be a part of your budget. Well, first of all, you will be paying for a basic term life insurance policy. And again, that's one thing. It says that if you're working 30 hours a week, you're full-time, you receive a term life policy in the amount of 1.5 times your annual salary with a maximum of $50,000. But the benefits are reduced to 65% at age 70, and when you get to 75, they only pay out 50%. Long-term disability. Long-term disability means that you have been unable to work for 180 days, and so basically you've missed almost an entire school year, and at that point they will pay 50% of your salary. Now, optional benefits, they've got medical plan, dental, flexible spending accounts. Now, they go through and start talking about the tax advantages. Again, I encourage you to go to this website and spend a little bit more time on it. But it talks about things that you need to keep in mind, okay, about the plan. And here it says medical and dental. And it says who's eligible, and it talks about the coverage. And we start to go down, and this is what becomes really important right here. The employer will pay $438.88 for individuals, $585.16 for employees, plus one, and $731 for families. Now, that's great. You say, well, isn't that nice? They're being so generous. Yes. Okay. Now, please note, for an individual, the employer is picking up all but basically about a little less than $50. But notice here, the employer pays $585, but the monthly premium is $975. Again, here for the family, $731. Well, you're paying basically $731 out of your employee's pocket to get family coverage. Now, why is this important? One, because you need to make sure that you know that you have to take that amount out of the salary. So you have to count that as, again, looking at it from the standpoint of income. You're getting that income for that. Now, but the main thing that you need to, as the person who has budget control, is this is what you need to know. If you have 10 people that are on families, you need to make sure that in your budget, under the category of healthcare expenses, that you allocate 10 times $1,462.88. So you need to make sure that you go through and see how many employees are single, how many are just using their single status, even though they might be married, because their spouse might have them on their insurance and it's cheaper. If you have very young employees, who are under 26. They could be under their parents' policy, and it might still be cheaper. But again, you need to make sure that you do that. Also, you need to make sure how many people are going to take dental insurance, because you're going to have to pay that bill. Because at the end of the day, you're going to be responsible for making sure that all those bills are paid. You also need to look at the short-term disability. What are you paying for short-term disability? Somebody breaks their leg, tears their Achilles tendon, and has to have surgery. They're going to be out for 6 weeks. What do? At what point do you start paying them? Do you keep paying them even though they're not working and you have to hire a substitute teacher? That's why you have short-term disability coverage. And then again, health insurance and the portability. Flexible spending accounts, that basically says that are your employees going to contribute to that? And again, you need to make sure that you have that set aside. Now, I give you this because as you look at it, there are lots of different things, that you need to consider as you consider budgeting for the following year. You have to make sure that you have a clear understanding of what the benefits are all about. Because at the end of the day, you're the one that will be required to go in and pay for those. And again, when you suddenly start looking at, in this particular case from the Archdiocese of Louisville, you look at their retirement plan. And their retirement plan, this was effective as of 2006, and you'll see all of the different avenues. What does it say? It says your employer established a retirement plan to reward you for your long and loyal service by providing you with retirement benefits. Each plan, the employer may authorize a certain amount be set aside in a trust fund, which is divided into separate employer contribution accounts for each participant. When you retire, you receive an employer contribution account and your deferred contribution account. Okay, what does that mean? The employer contribution account, that is a defined benefit. The deferred contribution account, that is basically a 403B. Now, please note, this plan is not insured by the Pension Benefit Guaranty Corporation set up by ERISA. It says the PBGC will not insure profit-sharing plans against plan termination. So, what does it say? It says that, again, number of hours of service. Now, in this particular case, it also says diocesan priest. When can I do it? How much may I elect to have my salary reduced? Again, you can make that election. It basically says you can defer 5% of your salary. Okay? Your decision to make a salary deferral is strictly voluntary. You don't have to do that if you don't want to. Okay? Now, again, this is important for you as you prepare your budget. After you become a participant, a portion of the employer's contribution is added to your employer contribution account. Okay? The portion that is added to your employer contribution account equals 6% of your compensation on a payroll period basis. What does that mean? That means that you need to go through and say 6% of all the salaries will go into retirement. Now, why is this also important, this one line here, on a payroll period basis? Because as you start looking at your cash flow management process and your cash flow analysis that we've talked about, you need to make sure that you clearly understand when you will be putting that money in. Now, some employers will say, I do it once a semester, at the end of the first semester and at the end of the second semester. Now, some employers, and this is what most people are doing now, is that on a monthly basis, we send that to the account. Why? Because that means the account is getting more interest on it rather than it just sitting there in the school's account. And again, if you get a chance and you want to learn more about it, read through this document from the Archdiocese of Louisville. It's a well-done document. And again, you can see here some examples they give. It's a great starting point if you're unfamiliar with it. Now, in this particular case, it says that the part that you're deferring, your voluntary contribution, are valued on the accounting date. The date generally is June 30th. However, effective on July 1st, 2006, your accounts will be valued on a daily basis. So if you retire tomorrow, you should be able to call the diocesan office and find out exactly how much you would get if you decided to leave. And then it breaks down here, what if I'm disabled and so forth. Okay? And again, we're talking about vesting. This is really important. And as you, as the head of the institution, as you're hiring people, this becomes very important. Because people need to know that if they leave within 2 years, they get no retirement, even though they've put in terms of the employer contribution. They get whatever they have back, but in terms of what the employer has put in, they get nothing. And again, if they leave before 3 years, they only get 25%, so it'll be almost negligible by the time they retire. It might be $10 a month or a year. So in this case, you're fully vested after 5 years. So if you stay 5 years, the money that's accumulated is actually going to be yours at the time you retire. So again, that's really important that you look at this. Again, as you look through your own situation in your own school, see how it compares to this. See if your teachers understand it. And if not, I would strongly encourage you to get someone from a diocesan office or get someone from your health insurance company to come in and make a presentation for your faculty. That will help with faculty morale. Why? Because they will realize that you're concerned about them and their future, not just them as a worker bee that comes in, does the work, and leaves, and at the end of the day, you couldn't care less about them. This is really important. I hope this information helps. Again, looking at two different programs. This is the Archdiocese of Louisville. In the other video that you've just seen, it was the Diocese of Sacramento, California. I hope this helps. As always, if you have any questions, please feel free to give me a call, and we'd be more than happy to talk to you about it. Thanks again, and have a great day.